We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Don Durrett, author, investor, and founder of goldstockdata.com. Don, how are you today?
Hey, thanks for having me back, Tom. We always have great talks.
Absolutely. It's a great pleasure to be able to catch up with you every time that you see a real inflection point coming. You know, you and I kind of schedule these talks a little while in advance. Usually we have a little discussion at the end and say, you know, this next time should be a perfect point to be able to discuss some really interesting and consequential pieces of news and or things that have changed for not only the economy, for the Fed, for the gold industry, all of it. But I want to kind of start by framing a little bit today's discussion by asking you if the past 2 years, the actual, economic, financial, federal policy or Fed policy environment is something that gold should have done well in.
Yeah. Well, it's doing well for kind of the wrong reasons. It's doing well because of, the U.S. economy is getting weaker and weaker and weaker, and gold is sniffing that out. And the reason why it's getting weaker is like the middle class is slowly its cost of living is making more expensive for the middle class to pay their bills, to get ahead, pay for education, pay for expensive cars, pay for expensive houses. So the cost of living has really created a real dent, if you will, in the U.S. economy. And I think, and you look at that, so the U.S. economy is 25% of global GDP. And I think that the world kind of recognizes that the U.S. is in trouble here. We've been in a bull market since 2009, 15-year bull market. And I think the world and the markets are starting to realize that can't last forever. And what's going to happen when this bull market finally ends? What's the ramifications? You have that going on, which is helping gold. I think gold has been leading since March. And it's all this uncertainty about, what's next. And then you have what's happening globally. So I think the Ukraine war was a really massive pivot point for U.S. domination globally. I mean, the U.S., the dollar is still the reserve currency, but the G7, the G12, the U.S. really has dominated global international trade rules, that whole thing. And the U.S. has really been in the driver's seat there. They've been able to basically be a bully and do what they want, as far internationally, as far as, how all the rules and everything. And then once that war started in the Ukraine, that all started to change. You had Russia and China align, and they're natural enemies because they're in the same area of the world, and you can't have two leaders in the same part of the world. Someone has to kind of dominate, if you will. And then because they want to have influence around them, right? And so they're natural enemies, and now suddenly they're best friends because of that, because of the war in Ukraine. And then you have China also. After that war started, China has been becoming more and more of an ally in the Middle East. You have Iran, Saudi Arabia, and now Turkey. All the big three. Just this week, Turkey said that they now want to apply to join the BRICS. Well, the BRICS was kind of a non-entity prior to the Ukraine war. So all that is supporting gold in a big way. And now we have the BRICS conference coming up here in October, and we'll see what they say about gold. Last time it was a nothing burger. I'm hoping it's not a nothing burger this time, but I'm not super optimistic that they're going to say, this is what we're going to do, and gold is going to support this currency. I'm not super optimistic, but it's possible. But what I do think they're going to say is we're working towards it. And so that will support gold to a certain extent. But they're also going to talk about how they are going to continue this move away from the dollar and more of this economic alignment between themselves. And so the U.S. is kind of the odd man out. which is the reason the Ukraine war happened, by the way. The Ukraine war happened because the US didn't want to get marginalized. Because if Russia becomes a friend of Eastern Europe and Western Europe, there's no reason for NATO. So the US had to make Russia the bad guy, the boogeyman. They had to be the bad guy. They had to be, even though they basically have been, a democracy since 1989, Putin has been the leader. So we basically point at him and say, they're not a democracy, they're the bad guy, evil empire still, right? We had to make them the bad guy because if we didn't, we're pushed out of Europe and we're marginalized. That's the reason that war happened. The media won't tell you that, but that's the truth.
So Don, now that we're facing rate cuts here in September, coupled with the uncertainty of the election, looming wars, as you said, and unemployment looking to be starting a negative trend, does that actually make a far more, positive environment for gold?
It does. That's the reason why gold's been leading, because there really isn't a path forward where gold doesn't do well. Even Wall Street is starting to figure this out, even though, investing wise, they're not talking about gold stocks yet, and they're not really talking about gold so much. But a lot of the banks are putting higher targets. They are recognizing that there really isn't a path here where gold gets beat up. That's why I say I think the floor for gold is 2,200. Mm-hmm. We might not even retouch it. And the reason why is because gold and the economy are really adverse. I always say the economy is the kryptonite for gold. So if the economy is doing well, you can go back to the 1990s. This is a perfect example. In the 1990s, the U.S. economy was doing fantastic for that whole decade. Well, gold was $250 an ounce and couldn't do nothing. It was basically flatline all day. Nobody could care less about gold. Mm-hmm. And gold does poorly when the economy is doing well. And then in 2000, we had the dot-com bubble bust. And then 2001, we had 9/11. And then 2007, we had the GFC. So we had three massive events in a row that created uncertainty. And what did gold do? It did well. So gold did well in the 70s, which we had two oil crises. We had inflation. We had stagnation. Probably the worst economy we had was from 77 to 80. Mm-hmm. And gold went crazy. It went from $35 to $850 in that decade. And then gold went from 250 to 1900 in 2000. So gold does extremely well during periods when the stock market does poorly. And so that's why I say gold right now and the miners are set up here when the economy turns over, just like those two eras, the 70s and the 2000s. I think that's coming back in the next 30 to 90 days. Mm-hmm. And when it does, I expect gold to be a star. It's been leading this whole year, but literally be a star where people are buying gold and people are buying silver as a proxy. Mm-hmm.
So, Don, how far do you think the Fed will go with rate cuts? Does higher for longer mean that they really still have room to cut rates, but still, relative to pre-COVID levels are still higher than that?
Yeah, this is really fascinating. And this is where I don't think people realize the trouble the Fed's in here. So if you go back historically, we've never had a debt problem or, basically a debt problem like we have today. And so the Fed has always had tools to fix problems. So if you go back like 1970s, late 1970s, Paul Volcker, he raised the federal funds rate to 15% or 16%. Mm-hmm. And he could do that. He could basically get away with it because we weren't over leveraged. We didn't have a financial system that was going to burn to the ground if we raised rates that high. We didn't have all that leverage in the system. As a matter of fact, in that period, we had less than $1 trillion in debt. So we didn't have a debt problem. So he basically did whatever he wanted, and he did it, and it worked. But today, you can't kill inflation that way. You can't raise rates. They got them up to 5.5%, but I don't think they really killed inflation, and so inflation's still here. Whereas Volcker, he literally, he wiped it out. So the other problem the Fed has is if they can't lower rates back to zero anytime soon. They have to go slowly. Remember, they raised rates really, really quickly to 5.5, and everybody was saying, "Wait, well, so you go slower." They went too fast when they raised them. Now, I don't think they're going to make the same mistake going down, or they lower rates. Get rates like by March of next year. I don't think you're going to see the federal funds at 3. It's going to take them some time to lower these rates, which is going to be problematic for them. But the other thing that's going to be a big problem for the Fed, and I think this is kind of, which is really the big problem for them, is the debt problem we have, the leverage in the system. So since the debt is so high, if they start trying to do QE, so the economy slows, they lower rates, but simultaneous to that, if they also do QE too rapidly and add more debt to the system and add more instability to the system, it's gonna break things because of all this leverage we have in the system. So they're actually in a fine line here, and I think what's going to happen is they're going to try to go slow, just like they did before. On taking rates back down, they basically, they didn't lower it. They were very patient. I think they're going to be somewhat slow on how they cut and then how they print money. And so the economy, when it goes into recession here, I think what's going to happen, they're going to be behind the 8 ball. So the economy is going to, and I think the stock market is going to lead. I think the stock market is going to be the trigger. The stock market is going to go down. We'll talk about the levels. Stock market is going to go down, and then the Fed is not going to aggressively try to nip it in the bud. I think they're going to go slow, and as they go slow, I think things are just going to slowly deteriorate on them, and they're not going to be able to get ahead of it. And it's just going to get worse kind of thing. And then over a period of 6 to 12 months, people are going to realize there's nothing the Fed can do. And that's the worst case scenario. That's when the Fed is perceived as feckless. They can't fix it. They can't get us. They cannot fix the economy. We're stymied here. It's going to be like Japan all over again. Japan in the early 90s, they couldn't get their economy going again. They couldn't restart it. And it was interesting that MMT, debt was the reason why they couldn't restart it. Debt is problematic. And we adopted the same thing the Japanese did with MMT. We basically said, debt doesn't matter. We can have $35 trillion national debt. It's okay. We can just keep blowing that bubble up. It's not problematic. Well, guess what? It is problematic. And I think it's going to show its head once the recession starts. And I think eventually what's going to happen is the Fed's going to get into a doom loop. And what the doom loop is that's when foreigners start to realize, the Fed, they're kind of screwed here. As they print more money, as they have to buy more and more and more bonds, that as they print, inflation goes up. As inflation goes up, the dollar goes down, interest rates go up. How do they stop that doom loop? They have to stop printing. But if they stop printing, the economy crashes. Mm-hmm. And so I think over the next 3 years, that doom loop will manifest in one way or another. And eventually, there's only one way out here, and that's the federal government has to cut spending because the Fed can't print all that money. The Treasury and the Fed are actually going to have a meeting sometime, not this year, not next year, probably late 26 or 27. They're going to have a meeting and say, okay, we have to cut. This isn't working. It's just not growing. We're not doing anything. I call it muddling. So we'll muddle for 2 years, and then 27. It'll be ugly.
So, Don, to your point about, cutting rates and basically the Fed's fight on inflation, I recently saw a chart that Zero Hedge posted that showed CPI now versus CPI in the 70s. And it literally, the next move up in the 70s was up to 12% for CPI. Yet the Fed is, starting to cut into this, obviously, it's not going to be an exact replica, but history does rhyme. So, do you think we get a near mirror image of the 70s inflationary cycle, or is it different this time, considering those levels of depth that you're just mentioned?
Yeah, absolutely. I'm not in the high inflation camp. I don't think it will bounce. Like last time, I think we got to 7 or 8%. I don't think we'll get to 10. I'm not in the hyperinflation camp because I think we're going to have a lot of deflation in assets, which will offset a lot of this. Plus, we were also going to have a sluggish economy where people don't have pricing power. So there's going to be downward pressure on a lot of pricing. But what we will have, we are going to have stagflation, but I think it's going to be more in the 5-6% area, maybe 7%. But that's ugly. 5% inflation is ugly. Mm-hmm. 4, 5, 6, 7. I think that's kind of what we're gonna see, which is going to be really, really nasty. But I don't think we're going to see 8, 9, 10 for the reasons I just said. I'll be surprised. And the people that say 15, 20, I just don't see that because we're going to have so much deflation. There's going to be so many assets that basically get really whacked hard. Stock market, real estate, and then boats and cars and used cars and stuff like that. A lot of assets are going to get whacked really, really hard. People aren't going to have money to spend. A lot of downward pricing pressure there. But one of the areas going to be really interesting is going to be rent. Because people aren't going to be able to pay the rent, and what kind of pricing power do they have on rent? Are rents going to come down? Are they going to stay flat? Are they going to grow? That's kind of an unknown. But I do think that we're going to have a housing crash to a certain extent. 20%, 25%. We might not get 25%, but I think 20% is definitely in the cards. Starting, soon, where it starts going down. Mm-hmm. And over the next 12 months, I think it's going to, once that's inflation. One thing, the bed and breakfasts, B&Bs, I think those are going to get sold hard. And so there's a lot of them. And so that's going to create a lot of inventory. And then you're going to have a lot of foreclosures that will create inventory. So I think inventory will explode, which will depress the prices. You might only see a 10% drop in places like Las Vegas or Phoenix where you have a lot of demand. But places where you don't have demand, I think that's where you're going to go down, 20%, 25%.
So Don, as we're thinking about the strength or let's say the trend of the economy right now, what do the revisions in many of the official data like the GDP and unemployment numbers tell us right now? Is the economy actually in worse shape than what is being presented? And do these revisions show, a much clearer picture?
Yeah. So I've been following the economy very closely all year. And, the stock market has been held up, and the Wall Street analysts and the Wall Street economists, they can say that they were right. But they've been cherry picking the data to a large extent. They've been looking at GDP very strongly. So as long as GDP is, it's been like second quarter was 3%. So they're looking at that number thinking the economy is strong. Well, one of the reasons why you have high GDP, it's kind of a fake number because they count the deficit, the government spending, which is at $2 trillion. If you cut that in half, the growth rate's like 1.5, which is, the GDP is misleading. The other one is employment. They say employment is strong, but employment has been trending up for 12 months. Full employment has been negative for 12 months. It's all been part-time job. So that number is misleading. And then they say the consumer is strong. Well, that's total BS. This week, Dollar General and Dollar Tree, if you go look at their charts. Those charts are pathetic. All they've done is crashed, and all they do is report over and over again, the consumer's weak, the consumer's weak. Mm-hmm. The only retail outlet that's really done well is Walmart. If you take Walmart's in their earnings, if you take it out of the retail sector and then you balance all the rest of them, it's negative. Retail is bad. They call the retail apocalypse. Over 3,000 retail outlets closed. And then you look at the wars. Look at the fast food wars we're having, the $5 meal deals, right? Everybody has them. And the reason why is because they're fighting over customers because there's not enough customers. Mm-hmm. So Wall Street is trying to tell us one thing. They're trying to tell us the economy is strong. I think they're talking their book, and then they also use the stock market as their data point for the economy. Their stock market's up. But if you look at the stock market, it has an earnings of about 2021, which is historically high. I mean, it was a crack up today. To me, today, Jenny Harrington, and she's really been the only one that's been basically, kind of throwing up a red light saying, hold on a minute here, people. She's been, one of the things she's been saying is that the math doesn't work. And what she means by the math, and the other thing she says is that valuation matters. And what she says about earnings is that, look, we're at 2021 today, but forward earnings are at 21 at where we're at today at 40, at 5,500. We're at 21 already. How are we going to grow? How are we going to, we're not, and they attack her. Today they attacked her and they said, the judge basically, I thought it was really kind of rude of him, really. He said, because he was instigating that she was, she's a bad analyst. He was going, people have had that same outlook for 18 months and they've been steamrolled. I mean, it was bad form on his part because she's right. She's right. The markets are basically in a bubble right now and they're ready to roll over. So I think that can be our next discussion. But then before we do I want a few more data points on the economy being weak. So the JOLTS came out for July, 7.6 million. In June, they were 8.1, so 500,000. So the JOLTS number has been crashing. Those are the number of job openings, and I think they're going to continue. The Beige Book came out today. There's 12 regions in the country. Only 10 of them had growth. The other 10 were flat to negative, which, so then you had home building. Home building has been, it was down pretty significantly in July. That's actually a problem. So, where are the green shoots? Where's the sectors? Construction's off, trucking's off, retail's off. Where's these green shoots? We're going to cut rates 25 basis points. Well, actually, right now it's 50-50, 50 basis points, 25. I think they're going to cut 50. And the reason why I think they're going to cut 50 is because I think the Beige Book, I think the economy is weakening slower than they want. And I don't think they want to, they don't want to get too far behind the eight ball here. If they do 25 basis points, it's going to be a mistake. If they do that just to look good, it's going to be a mistake. But I think they have enough cover here to do 50 because the expectation is a 50-50, and that's probably enough cover for them. I don't see the data numbers get any better between now and the 18th. I think data is going to get worse. I think the stock market probably is going to start getting weaker here. I want to talk about that, but I'll let you ask another question.
Well, Don, one of the other things that was pointed to for some of the market volatility was the Bank of Japan coming out and saying that they were going to raise rates if their outlook is realized. So why does the market have such a violent reaction whenever the BOJ comes out with any kind of news?
The reason why is because the yen carry trade, it's not just the Japanese that use the yen carry trade. It's also Americans. It's also Europeans. It's also, Asians. So what they do with that yen carry trade is it creates liquidity in the market. So they're able to borrow money at zero interest is basically, you have good credit. It's like, okay, I have good credit. Give me $20 million. I'll take that $20 million and I'll go invest it. And one of the places they invest is in the U.S. Well, whenever that yen carry trade reverses, then the liquidity dries up. That's why you had the violent trade. It's all about liquidity. It's like free money. It's like, oh, I can borrow at zero and I can invest it's pretty, it's not that difficult to get a return. And then they leverage it up, which is insane. They'll borrow at 20 million and then they'll leverage it like 5x, 10x and invest that. So that's the reason why there's a lot of paranoia about the Japanese raising rates. They raise rates, that yen carry trade, liquidity dries up, and it affects all the markets.
So then, is that one of the major catalysts, do you think, that ends this 15-year bull market on Wall Street, as you put it?
Well, I think that is more a thing about things just have beginnings and endings. Relationships end over, at a certain time, they just end. I just think that, I don't know, it's hard to predict what the trigger is, but I think it's a lot of different data points, a lot of different facets that are pressing down on the U.S. economy. But the biggest one by far is the debt situation and the consumer running out of money and the high interest rates having the lag effect. All these things have an impact. You're seeing it in the retail, how that's weakening. We're seeing the job market weakening. We're seeing that lag effect starting to bite. And then on top of that, 15 years, it's a long bull market. These things do end at a certain time. They do end. It just feels like like Taylor Fritz. I mean, one of the things he said, he goes, this felt like it was my time, because he'd been to 4 quarterfinals. This is the 5th one. It's like, gosh, I've been to 5. I'm due to win one of these times, right? Mm-hmm. And he felt like, today it felt like it was my time. Mm-hmm. And he was confident. It was he felt like he was going to win, and that's, confidence is huge, right? And so that's how I kind of feel about this market. It just feels like this is the right time. We had that event in July where we had that open up Monday, and the VIX went to like 60. It just exploded, right? In one day. I went 15 to 60 in a single day. Then Monday, yesterday, 2 days ago, we had that. No, it was Tuesday, actually. We didn't have trading on Monday. Yesterday, the VIX actually popped to 23, which is a big move for the VIX. I think it went from 15 to 23. I mean, it was a big move yesterday on the VIX. So people are nervous. And so we're seeing the volatility. And so, like I said, and everything's coming to a head. This election that's coming up in November is massive. It's huge. People tell me, oh, no big deal. I keep reading over, and it doesn't matter. The Democrats do better in the economy than the Republicans. Doesn't matter who wins. BS. It matters hugely.
So what are the biggest differences between a Republican and a Democratic win, going forward for the next 4 years?
I would explain it to you, but it'd become too political. I don't want to make this a political conversation. But really what it comes down to is both parties have a different approach. And that different approach is meaningful, really meaningful, because both parties now have a significant different approach. It's not a little one. It used to be a little one. Back in the 1990s with Bill Clinton was basically a moderate Republican. The Uni Party existed big time in the 90s, big time. Mm-hmm. That's not how it is anymore. Now the Democrats and Republicans have different philosophies, different approaches. Like they might as well be leading a different country. It's gotten that extreme. And everybody knows it's extreme. So this is a massive. And so the fallout is going to be massive. And the fallout to financial systems, financial markets is going to be massive. And and it's going to be really interesting. I think Q4 is going to be totally wild, absolutely wild.
Mm-hmm. Do you think we could kind of distill it down into more regulation versus less regulation, or is there an easy way to kind of summarize the difference?
I would say it gets really, really complicated. But what it really comes down to is free market versus government, government control, kind of fascism, if you will. Mm-hmm. Trump will America's always basically been built on this idea of kind of free markets. And those free markets have been slowly, getting squeezed, where the corporations have become more and more, powerful. They even say the Republicans are fascists because they work in tandem with corporations. But the Democrats on the other side, they become less market oriented. They're like the economy, we can basically, give people money, have bigger programs. It's not going to impact things. Government oversight, government programs, everything that'll all work. It's not going to impact things, but it's really starting to bite a little bit. I mean, if you look at Harris, if you look at her, what she really wants to do as far as increase taxes, she wants to increase corporate tax significantly. She wants to, she's talking about unrealized gains, which is unbelievable. These are really dramatic shifts in what America has always been, focused. But the big one really is, regulations. You mentioned regulations. That is hugely impactful. But really what it comes down to is, what is your priority? Is your priority economic growth, or is your priority social growth? Social/equity growth. What is your priority? Mm-hmm. It's really hard to do both. And that's the big flip here. And and the Democratic Party has been making baby steps towards that shift, towards focusing more on social growth than economic growth. It's like we don't necessarily need economic growth. It seems like that's kind of their mentality. It's like, oh, we raise corporate taxes, okay, the economy slows down, so what? Kind of thing. That's why I'd say it's becoming very significant, and I think people realize that. But yeah, small businesses in this country, that's a big one, right? So small businesses in the country, it's becoming more and more difficult from regulations and taxes to start a new business to make money. I forget what the data is, but it's something like after 1 year, the number of businesses that succeed, the percentage is terrible. And then after 3 years, it's like pathetic. And one of the reasons why is because businesses cannot afford those extra taxes, extra regulations. It becomes untenable to make a profit. Mm-hmm. That is, and small businesses is kind of the engine of the economy. And then you throw in, so that's happening. That's kind of the undertone. But when you throw that in with our debt bubble popping, which it is popping. I can hear the popping sound right now. I mean, you look at commercial real estate. I mean, that bubble it's popping as we speak here. That's not, I mean, commercial real estate, I mean, it's the valuations have fallen through the floor and they're not coming back. So someone's going to lose money there. And so that's all going through the system right now. There's no green shoots. I mentioned that. There's nothing going to get us on our feet. I mean, usually to get you on your feet, you kind of have to have kind of a Phoenix scenario where you kind of have to burn everything to the ground economically, and then the green shoots come up and you get this new business cycle. Well, there's not going to be a new business cycle this time. That's what I've been predicting. There's not going to be. We're going to get to January 1st. I've tweeted this, said it many times. We're going to get to January 1st this year. We're going to say what just happened, mm-hmm. because Q4 is going to be so wild. What is the path forward for this country? And we don't have one. I mean, that's really going to be the takeaway, is that we don't have one. We don't have a path forward, not as a country as a whole. Each group each group is going to have their own idea of a path forward, but as a country, we won't. And so it's going to be really dramatic, I believe.
So Don, if we get this pop on Wall Street of that asset bubble, what happens to gold and silver in that time?
Yeah, so that's the reason why I got into gold and silver, because it's really the only asset that benefits in a big way from that type of a situation, because it doesn't have any counterparty risk. It's the only thing. You could say Bitcoin as well doesn't have any counterparty risk, but gold and silver, if you have a bar of gold in your hand, it's your gold and there's no counterparty risk. It's just valued, globally, unless your country, does put some type of regulations on it. The counterparty risk is government regulation, government taxation, of course. But I've been saying that, if you get a debt bubble pop, people, that's the reason why people talk about silver and gold with these huge numbers, these huge targets. I mean, I use $3,500 gold, $100 silver as my targets. And that's 30 and GSR of 35. I think that's totally reasonable. That those targets are totally reasonable. But most people have much higher targets than me. Mm-hmm. And that's why they have higher targets, because if this debt bubble pops, there's not a lot of places to run to. And so I've been saying that the people that are going to buy gold and silver, especially silver, they don't even know they're going to buy gold and silver. They don't even know it. Mm-hmm. And the reason why is because currently they have money in the stock market, they have money in the bank, they have money in 401k plans. And that's where their money is. And they're basically think that that's all they need. They don't own any gold and silver. They don't have any physical gold and silver. And they think that's good. They have confidence in the dollar. They have confidence in the U.S. economy. And that confidence is going to dry up. And when it dries up, people are going to go, I'm not really super comfortable having all of my assets in dollars and stocks and bonds. I'm not real comfortable with that anymore. What's my alternative? Well, gold and silver is really your only alternative in crypto. And so that's the reason why I got into this, because I saw that basically using debt to grow GDP is a temporary, basically a temporary fix, if you will. It works for a short period of time. There's no difference between you basically getting out of college, getting a job, and getting a credit card for $10,000, and it has like a $10,000 limit, and you basically you run that thing up, and they basically, call you on the phone or whatever, send you an email and say your credit, they pull the rug pull you. You don't have any more credit, you can't use it, but you still have to pay your debt back. But the key thing is that your credit gets turned off. If you go past a certain point of no return, once you go past that point of no return, you get rug pulled. Your credit gets rug pulled. Well, the U.S. debt eventually will get rug pulled. That's just how it works. We're not the only country that's lost its credit. It's happened to several countries where basically had to default. And so that's going to happen to the U.S. And that's why I own gold and silver, is for that reason. The bond market. The bond market is another thing that most investors don't know. The bond market is much more important than the stock market. Much more important. Mm-hmm. They always talk about, the stock market going down. Everybody's eyeballs are always on the stock market. But the bond market is much more important because that's where all the credit is. Stocks and bonds can go up and down, and wealth goes up and down. But when credit gets turned off, you have ramifications that just reverberate throughout the economy. It's huge. And so it's the bond market. The reason why you want to invest in gold and silver is not because of the stock market, it's because of the bond market.
So is that because of the importance to, everybody buying that debt, that long dated US dollar in a way?
Well, our debt, our $35 trillion in debt, is predicated on the strength of our economy. So you have to generate enough wealth to basically service the debt. And we're able to do that today. But at a certain point, you can reach a point of no return where you can no longer service the debt. And we can already see it. From 2008 until 2020, our increase in our deficit was averaged $1.3 trillion a year. From 2020 to today, it's jumped to 1.8. And so we're currently, and that's where we're at today, 2024 at 1.8. 2025 is going to go to 2 and maybe 2.2 because we're going to go into recession. Whenever you go into recession, your deficit goes up. Mm-hmm. So we're at almost $200 billion a month we have to borrow. Remember I said that point of no return. So at a certain point, there's not enough demand, if you will, to buy that debt. And that's when the doom loop stops, because that's when the Fed has to print it. And if you start printing your debt, you're kind of eating your feed corn. At a certain point, it doesn't work anymore. You can't, because you destroy your currency. Mm-hmm. You just can't print. That's kind of the Weimar. You just can't print to infinity. And then inflation, this is the other thing, is that inflation is the weakness of a debt-based system. So we're a debt-based system today. We basically keep expanding. We're expanding the debt faster than our GDP, much faster now. It's like we're expanding the debt about 8% a year, and GDP is about 2%. So 4x, our debt, we're expanding it now about 4x. It's out of control. And so at a certain point, you're not generating enough wealth, and everybody knows it, and things just start breaking. For instance, when we go into the next recession, there's going to be a lot of corporations that need bailouts. And the Fed is initially going to try to bail out everybody, but they won't be able to bail them out. They won't be able to bail out all these banks. There's going to be a lot of regional banks that go under. Mm-hmm. The Fed is not going to be able to bail them all out. And so you're going to get a lot of bail-ins. And that's really when the emperor's show and the emperor doesn't have any clothes on, is when you have a regional bank go under and people go, I never thought that would happen. I always thought, the Fed would make them whole. How they didn't. They basically didn't make them whole. And that's when things are going to really get wonky. And that's what I think is coming.
Mm-hmm. So, Don, a question I've asked many guests recently, and I'm really sorry for the repetition for the audience, but I think it's instructive to get, everybody's viewpoint on this. I've heard it said many times that what happens to gold miners in a rate cutting cycle is that they finally catch fire. How do you see that, a rate cutting cycle being a catalyst for gold miners?
Well, yeah. So I believe that history will rhyme, because history, whenever they cut rates, the first rate cut is generally when the recession begins. I mean, you can go back and look at every single time a recession's begun. It's like they cut the rate and bad things happen. Mm-hmm. Wall Street think, it's going to be different this time. They're going to cut rates and the economy is going to get better. And I also think that the rate cuts are not going to help the economy. They'll keep cutting, but the economy won't grow. Our economy is based on growth. We have an economic system. It's grow or die kind of. You're flat or you're down. You go bankrupt. There's no such thing as a sustainable company. We don't go by sustainable. If you're flatlined or you're negative, you either go under or somebody will buy you out, or you're going to have a problem. We're growth oriented is my point. Mm-hmm. So if these rate cuts don't get the economy growing again, then uncertainty will arise. And if uncertainty arises, then gold will outperform the stock market. And that is the perfect scenario for gold miners. Because if gold is outperforming the stock market, then the margins on the miners are improving. And if the margins are improving and they're making money, the miners are going to do well. If you go back and look at the miners from 1977 to 1980, mm-hmm. they totally ripped faces off. The miners, the economy was in stagnation. That was one of the worst economies ever. And these miners were just ripping faces off. I mean, you go back and look at some of those returns and you're like, what? That happened? Did that really happen? I mean, it's kind of crazy. The same thing happened in the 30s, by the way. And gold was only at $35 an ounce. Mm-hmm. But the miners did well in the 30s because the markets were doing poorly. And then you go to the 2000s, the same thing. So I think that the rate cut will not help the economy. I think gold will outperform the stock market. I could be wrong. And if gold's outperforming the stock market, and those margins are everything. We need to have at least 30% margins for gold and silver. We're almost at 30% with gold right now. Right around there, 28, right around 28, 30% with the gold miners at $2,500 gold, maybe a little lower, maybe 28. Silver miners aren't even close. Silver miners are, anemic. And that's one of the reasons why the miner, the Hui is hasn't broken out yet. But I think that once the fear trade arises and gold gets going again, I think that silver always does this. Silver plays catch up. Silver will outperform gold in a big way. And then once silver has those margins, look out for those miners. The miners are going to rip faces off. Now, I don't think that the miners are going to do as well as they did in the late 70s or the early 2000s. They might, but the problem is that gold's starting at a very high level, and costs have really increased because of inflation. So even if gold goes to 3,500, most of the gold miners, we're looking at 3, 5, 10 baggers, which is good, but it's not kind of face ripping type of things. But some of the silver stocks very well could, because they've been so far behind the 8 ball for so long, and the inflation adjusted price of silver for 2011 is 68. So if we go to $68 next year, and you look at some of the margins, a lot of these silver miners will rip faces off. People will go, whoa, what the heck is that stock doing, kind of thing. Mm-hmm. That's definitely in the cards here. Now, again, I said this. I mean, what's important here is gold has to outperform the stock market, and the stock market needs to be flat to down. Mm-hmm. You go look at the S&P from 2001 to 2005, it did nothing. It was flatlined for 4 years. That's kind of what we need. We need the stock market to be flatlined for the next 2 to 3 years. Stock market flatlined 2 to 3 years, and gold to be trending up, which is what happened with gold from during that period in the early 2000s and the 70s. We need history to repeat, and then your miners do extremely well. Mm-hmm. As a matter of fact, they'll do so well. I plan to. Have sold all my miners before a lot of people even get into this thing. I mean, that's what my expectations are. Mm-hmm.
So, Don, do you ever watch insider activities for speculation ideas?
No, I watch insiders for gold and silver miners. Absolutely, because if insiders are buying, there's a reason for it. They're bullish for a reason. I mean, so I think insider buys or sells are very important. Sells can be very misleading because we don't know why they sold. Mm-hmm. They could be selling because they just flat out need the money, not because they don't think the stock's going higher. But if I think buys are very indicative of confidence. So yeah, I definitely. And one negative for me is when stocks are totally in the dumper and the board and the management isn't buying. Mm-hmm. I mean, stocks are like, why aren't you buying a little bit? I love this stock and you guys aren't buying none of it. That bothers me. So I think insider buying is important. Keep an eye on that. The best one is CEOCA. That website will show you all the insider buys, which is the only negative is you got to go one stock at a time, one company at a time. But if you're doing some DD or some research on a company, you can go and check their insider buys for the last 2 years, or even go back further than that. Mm-hmm. Perfect example is, kind of Free Gold Ventures. I mean, Eric Sprott, he's been buying the heck out of Free Gold Ventures, and now it's been ripping. I mean, I love that stock, but his insider buys was a real tell. I mean, he already owned and now he's up to 29%. But a lot of that was bought this year because he's but that was a real big tell. The other one, I think Jaguar was a big tell. Eric was adding. I mean, he already had a huge position. He's adding. What's he doing adding when he has so much? Mm-hmm. I think it's a tell.
So when a company keeps diluting their shares over time to keep raising money for, let's say, operations, how do you view that when considering if you should keep holding or maybe sell?
Yeah, it's a good point. This is something that you don't really learn about how to understand insider, when they're doing share dilution. It takes time. It takes years of experience for you to get a real kind of a gut feeling. And what I'm talking about here is investor. If a company is investor friendly, or if they're taking advantage of the retail, they're basically just using their shares as basically a money printer. Mm-hmm. And they don't, they don't really care that much. They care more about the business, kind of a conservative approach versus trying to do the best for shareholders. And I see it all the time. And so you get a feel for some of these companies, because for me, a lot of times they will do financings at the wrong time, and they'll do it for too much money. They just be a little bit more patient. And you could have done, for instance, silver, it got to $30, $32 in May. And I thought that, if you go back to October last year, October all the way through March was a real down period for silver, really down. And a good board, I think, team would have said, look, let's just be a little patient here. Let's just wait and wait for silver to make a little bit of a move here. Why should we be doing a financing when silver's at $22, $23? So we're seeing a lot of companies do financing when silver's basically bouncing on the bottom. You shouldn't do a financing when gold and silver, well, especially silver, because silver's been a laggard, doing financings when silver's totally in the dumper, and it was really bad form. And then when they do the financing, I always think that you should never finance in a single year more than 10% of your market cap. That should be your maximum. If you get by, if you can't get by in 10%, find a way, slow down, slow everything down here, people, slow it down. Mm-hmm. But what we see companies doing 15%, 20%, 25% financings because they can, mm-hmm. and then they'll do it at a full warrant. We just had Maritime do a 30%, I couldn't believe it, 30% financing, because they want to, move this stuff forward. Well, you got to realize, that's just going to hurt the shareholder too much. You can't do that. You got to be patient. Slow down. There's nothing wrong with waiting. Spanish Mountain is a good example. They've just been so patient. Most companies that own Spanish Mountain's project would have diluted us into the ground by now, but they've been patient. Got to be, don't do it. If 10% isn't, I'm okay with 10% annual, sometimes you need to do that. Developers and explorers, they don't have any income. They got to do financings. But you shouldn't do more than 10% a year. And when these companies do 15, 20, 25 with full warrants, the other thing that drives me nuts is companies will do a full warrant when they don't have to. I remember, I think it was Lion One, they did a full warrant and then they had oversubscriptions. It's like, if you got oversubscriptions, you don't need to do a full warrant. Mm-hmm. I see that a lot. A producer doing a full warrant? Come on, man. And shareholders and investors know that. In Line One, their share price has been in the dumper because people are upset with the company. You do a full warrant, you're going to lose a lot of retail, gravitas. Mm-hmm. These companies, but again, they abuse it. I see it all the time. They do, and that's how you learn. You learn this over time. Which companies are investor friendly, which ones weren't, and then you can just know it's coming. It's like companies, the ones that do it over and over again, you're going to keep doing it. You can expect more of the same kind of thing.
So is part of that as well, maybe a company not having a very clear defined roadmap or not achieving those steps along the way as they're doing those financings as well? Is that a red flag?
Yeah, this is huge. And it's a really good question. It's one that, again, takes years to learn. And what I have found is that the companies that have a strategy, have a roadmap, do a hell of a lot better on letting their investors know where they're going, how much money it's going to require, and everybody's on the same page. And the irony is that the ones that don't have a strategy or a plan, those are your serial diluters. I want to bring one up today, but I own the stock and I don't want you guys to go sell it. But you can see that these companies do not have a plan. And it's like, come on, man, it's not that difficult. You have a deposit, make a plan, do the plan, stick to the plan, pull it off. It's amazing how many companies have good projects with lousy plans. It's stunning to me. It's less than half of good projects. You look at a good project, only about half of them have a good plan. Or have a plan. It's kind of mumbling me. One of the things I say about developers, we're really talking about developers, not talking about producers. Producers always have a plan. Yeah. Now their plans might not be great, but they have one. We're going to keep mining this mine. We're going to do this much drilling this year. They got an idea what they're going to do for the next 12, 24 months. They got an idea. They have to, right? It's not easy to produce mines. But developers and exploration companies, especially developers, a lot of them, that's one of my important checkboxes. If they don't have a good plan, that's a checkbox. Then you need to walk away. Basically, they don't know what they're going to do. They don't have a plan. You're going to need to walk. Once in a while, I'll gamble, but I like a company that checks that box. Mm-hmm.
So, Don, is there anything that you'd like to leave our listeners to think about, maybe to mention that you're particularly worried about going into this election, or maybe even something that you're feeling positive about in the next, let's say, 6 months?
Yeah, that's a big topic. But before we go there, there was some things I wanted to talk about today we didn't get to.
Okay.
So the first thing I want to talk about is the stock market, where it's going, where it's at. I really feel that, my newsletter that just came out 1st of September, I talked about that a rug pull's coming. And I also said I'm on the sidelines. I usually buy stocks the first of the month. I didn't this month. I didn't buy any. I actually bought some crypto because I'm basically on the sidelines because I think the rug pull's coming. And what I see coming here, I just think the stock market's out of energy going higher. And I know David Hunter thinks we're going to 6,000, 7,000. I don't think we're, maybe 5,700, maybe. I don't think we're getting to 58. I actually think the rate cut is going to be negative. Hunter thinks it's going to be positive. We'll see what happens. But I think that the stock market is anything above 5,200 on the stock market. Wall Street's going to remain bullish. Down to 5,300 especially, but even 53 to 52, I think they'll be bullish. You won't hear a lot of people screaming, run for the sidelines. And then below 5,200 to 5,000, that's going to be your first kind of nervous zone. A lot of people will stick in, from 5,200 to 5. That's kind of when you're early. That's going to be the smart money is going to be leaving, 5,000 to 5,200. But most people are going to, we're okay. Then the next one, 5,000 to 4,800. That's really the danger zone. That's when a lot of people will start jumping out. They're like, okay, we're below 5,800. I'm out of here, kind of thing. And then the last chance is 4,500 to 4,800. And that's really, that's the last chance for the stock market to basically not die, not roll over. And that's when the bull market, 15-year bull market, it's got to get traction above 4,500. We go below 4,500 and it's lights out. Mm-hmm. So those are your zones, if you will, to keep your eye on. I've been saying the only thing to watch is the S&P. Just watch the S&P. If you stay above, but I think now we're heading to that rug pull. So I'm waiting for 5,200. So for me, it's like, la-di-da until we get to 5,200. And then below 5,200, it gets interesting. Then we see, okay, are we going to pivot? So the next 2 months, September, October, are going to be interesting to see if we get below 5,200 in the next 60 days. And then we get into November, the election, after the election. I'll be very surprised if we're above 5,000 at the end of November. I'll be wrong. I'll basically be wrong, but then we'll head into December. But then everybody says that you get the November effect. You get to the middle of November and the stock market starts just ripping higher. And I think this is where everything you talked about, what are my concerns around the election? So I can answer both questions at the same time. So the middle of November is really going to be the most important point of the whole year. Is the stock market, we've had one rate cut, maybe two rate cuts by then. Are those rate cuts helping? Is the stock market on its feet? Are we above 5,200? Are we above 5,500? And heading into the year and everybody's saying, oh, this is a great year. Everything's fine. I don't see that outcome. I see middle of November as all hell breaking loose. Mm-hmm. And we're below 5,000 and everybody's going, are we going to get this December, stock market up? And I don't think we're going to. I think it's going to be the opposite. I think it's going to be kind of a bloodbath. So, yeah. So my concerns are like middle of November. That's, so I'm looking, all eyes for me is on the S&P and then the middle of November, how the markets all react to this election. And so it's very dicey the next 30 to 90 days. But now, as far as, people are like, okay, where's the bottom? I think that gold will bounce. I've been saying this for a while. Right, somewhere around 4,800 on the S&P is when I think gold will bounce. So I think it'll bottom somewhere between 2,200 and 2,300. And when it bounces, I think that's when the miners hit their bottom. Like I think the Hui is going to bottom somewhere between 2,500 and 250 and 270. And my number is 263. I think the Hui is going to go to 263 and then it'll bounce and start going higher. So I don't think we have to worry. Silver, my target's 25 to 27. And I think 27 will maybe a hold, 26 will hold, and then gold 2,200. So we're basically going to get these cycle lows, I think, when the S&P gets below 5,000. So it's this could happen in September, but I think it's going to happen after the rate cut, which is September 18th. So let's see where the market's at September 18th, and then where it's at, the end of the month, where we're at, we enter October. It's going to be this. We got to get our popcorn out. This is getting really, really interesting.
Mm-hmm. Well, and I think for those that own, physical metals, you're able to sit back with some popcorn instead of, sitting there on the edge of your seat biting your nails.
Yeah, that's true. I always said that you need at least 1,000 ounces of silver. That should be your piggy bank. So we go to $100 silver. That's $100,000. That's a nice piggy bank. That should be your minimum, I think. But yeah, and as I said earlier, most of the people that don't own silver don't think they're going to own silver will own silver.
Absolutely. Don, I really appreciate you walking us through all these topics today and really laying out how you see the blueprint forward here for the next, let's say, 6 months. For those that want to read more from Don, it's all available at goldstockdata.com. Also, your Substack, Don Durrett, 2 R's, 2 T's. And also an excellent Twitter follow at Don Durrett, 2 R's, 2 T's. Don, thanks so much for your time today. Really appreciate it.
Yeah, one thing about the stock on my website. So my website is for people that already own gold and silver mining stocks. Mm-hmm. It's more of a data site than me picking stocks for you. I want you to do your own research. That's why it's data. Come do your research. But I help you. I give you a lot of data. I give you my own opinion I rate these stocks. So I give you tons and tons of leads. 850 names in my gold and silver stocks in my database. It's huge. But if you don't own any gold and silver data, you can read my book. It's on Amazon. And read the book first, and then maybe you'll get intrigued. But if you don't own any, then I don't recommend the website.
Excellent. Thanks so much for putting that database together, Don.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.